All right, let's look at PayPal. This video is a request. Obviously, a lot of people have been talking about PayPal on social media. I've so far avoided it, but I'm going to do my best to give some level of analysis and let's see what we're looking at. All right, so the basics, $60 billion market cap. Chart looks horrible over the last couple years. Um, I am interested in this low PE and forward PE, and I love a 9.5 percentage free cash flow yield, which is great, and the stock unlock score is decent. So let's hop right into it. All right, so as you can see, PayPal has a very good history of revenue growth. It has slowed over the past couple of years, but that's fine. The more concerning thing is the free cash flow growth is really non-existent. So that's going to actually be the main thing that sort of hampers being able to use a discounted cash flow analysis is there's no real major cash flow growth, as you'll see, if I move forward, zero growth, less than 2%. So we're going to have to be creative. But with strong revenues comes strong opportunities. Um, so what PayPal is looking to do is immensely buy back shares. So you can see here, this is sort of ramped up. See that compounded annual growth rate? It's ramped up. They're really accelerating their share buybacks, which is a strategy that a couple interesting businesses use, which is why using just a discounted cash flow analysis isn't really going to work. It could work, but projecting like the percentage of share buybacks is a little tough. The famous example I like to give is AutoZone. Um, this is a crazy chart of them buying back shares and reducing the amount of shares floating throughout the pool of shares available. And you'll see that AutoZone is an absolute monster because of this. And, you don't actually need to worry about their free cash flow, right? It's not really going anywhere. But if you look at their earnings per share, it's a 20% annual growth rate since 1991, which is absolutely insane. And that's how they provide shareholder returns. It's called cannibalism. They just aggressively put all of their free cash flow back into buying back shares. Now, PayPal is a different story because something I don't like about this is they have a huge amount of stock-based compensation. It is declining, which is good, but still well over $1 billion of stock-based compensation, and their research and development expenses are very high. So if you slap the free cash flow yield on here, the combined stock-based compensation, research and development is consuming almost all of the free cash flow, and then you add the interest expense from their debt in there, and you're not having a ton of cash flow that isn't affected in this case, which is a problem. And then if you look at the KPIs, you'll see that um, active users is growing. It's sort of plateaued, but it's not like it's a dying company. There's a lot of um, people still using this. There is an issue with declining number of payment transactions, which is a problem. But either way, looking back at the bigger picture, revenue's growing, free cash flow is not terrible. So if they were to just implement a free cash flow into stock repurchase program that could work. They would want to reduce their expenses. Um, I'd love to see stock-based compensation go down. If we look at, their balance sheet, it's decent. Um, you know, they have a lot of long-term debt. They're paying interest on this, which is fine. I mean, this is what these companies do. Um, so into the valuation, it was not easy to figure this out. So we're going to hop into Excel. This is what I decided upon using share buybacks, um, me hoping that they would be reducing their expenses over time. So the bear case is in 2030 that they would have a 7.5 earning per share with a 12 multiple, which would lead to a 43% gain or a price of 90. Base case is 8.5 earnings per share with a multiple of 14. Um, price 119, 89% upside, and then the bull case is 10 EPS with a multiple of 16 for a price of 160, which is 154% gain, which is huge. The challenge here is assigning a multiple. You could, AutoZone has a 24 multiple, so you could get a little more bullish on these. And these numbers would massively change. I didn't put them in the calculator, but you can see here it's a huge change in price as the multiple goes up. And I believe the market would be interested in some other cannibal stocks, payment type stocks like Fiserv and PayPal. Square are good candidates for this type of style. And the long and the short of it is that I'm not super thrilled about it, but I could see where if they grow their free cash flow on top of this analysis, they actually end up heavily outperforming the market. Analysts are all over the place. I try to use a combination of, their projections for what EPS might be, but also take into account that they're probably going to ramp up share buybacks. The issue with share buybacks is as the price of the stock rises, your dollar gets you less shares. So it's really hard to analyze like very long term. Even if they say they're going to spend $10 billion, it's hard to know exactly what the impact is going to be. The main bullish things for me, though, are the free cash flow yield is almost 10%, which is huge. I believe they're probably going to be over an 8 EPS in 2030. And then they also have the option of like Venmo or one of their other sectors really just taking off and boosting their free cash flow, which would completely change all of what's been analyzed in this video. Uh, Hope that was helpful. Thanks for watching.